Hi there, welcome back. In this video, you're going to learn some principles that apply to accrual accounting. In the world of accrual accounting, there are generally accepted accounting principles that govern how we do that. And today we're going to talk about the matching principle and the revenue recognition principle and understand why they are so important. So let's get started. The thing that we want to talk about today is this overarching idea of generally accepted accounting principles. When a company is governed by and has to use the accrual basis of accounting, there are certain rules that apply, and every company will follow these. So generally accepted accounting principles are the general guidelines that all companies use to measure and report financial results. And certain principles apply when it comes to timing issues. And what I mean by timing issues is that since companies have to cut up their year, their fiscal year, into these artificial time frames, that can generate some interesting situations where a company has to recognize certain transactions, and what that leads to are adjusting entries. And adjusting entries are things that I'm going to cover here shortly in some other videos, but know right now that because of the fact that this accrual accounting takes place in companies, we have to deal with certain things, and you'll see what I'm talking about in a moment. Timing issues are governed by two different rules. One is revenue recognition. Think of this as, when does a company fulfill its promise to provide a product or service? Okay, so let's use an example of Starbucks. So when we walk into a Starbucks store or any coffee store and we buy a coffee product, or we buy a bag of roasted coffee beans, when we actually go in and pay for that service and we get that cup of coffee or we get that bag of roasted coffee beans, then the revenue has to happen and be recognized at that point. So what happens is that when we ring that through the cash register, the point of sale system, back behind the scenes, there are computers out there who are actually tracking those sales, tracking that revenue, and it's creating those journal entries. Now, a lot of times in an accounting class, or when someone's trying to learn accounting, you actually do a lot of this stuff by hand. At least, thank goodness that a lot of this can be done automatically. But that's what we're talking about. Now, at the same time, if you walk into a Starbucks store and you walk in and buy a gift card, or a Walmart and buy a gift card, or buy an Apple iTunes gift card, whatever it is that you may buy, that card is not a sale. That is not a revenue generating event. And why is that? Because the company has not fulfilled its promise to provide a product or service. That little card actually represents that sometime in the future you will come back, or somebody that you give that card to will come back to the store and they will get a product or service. So it's only when that product or service is actually exchanged with the client who holds that card, that's the only time that revenue can be recognized. The second principle that we're talking about here is the matching principle. This is also called, you'll hear it called, the expense recognition principle. As we generate revenue in an organization, the corresponding expenses that are required to generate that revenue also have to be recognized. Plus, there are expenses that happen in a general nature every month or every period for a company. So let's take a look at this. If you go to finance.yahoo.com, there's a place on there where you can actually put in a symbol of a company. Like in this one, I'm using Starbucks as an example, and their symbol is SBUX. SB as in boy, UX. When you put in that symbol, down on the right hand side, the right hand column, or actually the left hand column, of the screen, you will find the financial statements down there, and you click on income statement. And this is an actual copy of what I recently pulled off for an income statement for Starbucks. So when Starbucks is selling coffee, either the coffee drinks, or they're selling the coffee bags, or they are selling coffee mugs, or whatever it may be, those things, when they are actually exchanged with the customer, will show up in that total revenue line. And it's only when products are actually exchanged, not the gift cards, that it will show up in the revenue. Now, there are direct expenses that generate that revenue. So, for example, when Starbucks is producing a bag of coffee, it takes coffee. There's a certain amount of packaging products they have to buy. There's a certain amount of direct labor that goes into that. There's a certain amount of overheads that have to do with the manufacturing facility that it's produced at. So there's all kinds of costs that are being captured during the production process. And only when we actually sell the product do those costs get recognized on the income statement. So when we make a sale, and I will detail this out in a future video, when we make a sale of a product, any associated costs with that product also get recognized at the time. And you'll often hear this called cost of goods sold. But as you can see from the Yahoo financial website, it's called cost of revenue. But cost of revenue and cost of goods sold mean the exact same thing. Now, here's also the same Starbucks example, but I'm showing a little bit more of the income statement. So here, what we see are some operating expenses, such as research and development, because those costs, we can have costs for that in any given period. It's just not directly related to the sale of the coffee. And general and admin expenses, those are things like, well, you have to pay a legal team, you have to pay a marketing team, you have to pay all these different groups of people who don't directly deal with the production of a product, but you still have to, they're still part of your business. And you will have periodic expenses that are associated with those groups. So that first part, the revenue and the cost of revenue, that is directly related to the sale of product. But then these operating expenses are these general expenses that every company will have. Now, in future videos, I will go through certain adjusting entries that will take place in an organization, and I'll refer back to this video each time I do those, because everything about those has to do with these two generally accepted accounting principles that we've detailed in this video.